What's up everyone? My name is Eddie and this is the Soaring Dividends YouTube channel. Today I'm going to go over 3 pros and 3 cons of dividend investing. Let's get to it. The first pro of dividend investing that I'll be talking about is purely amazing passive income. Dividend paying companies will pay you just for investing in them. They will return a portion of their profits in the form of a cash dividend back to you as a shareholder. These dividends are often given out on a quarterly, monthly, semi-annually, or annually cycle, and this just depends on the company that you're investing in. Companies with higher cash flows typically have a higher dividend payment in the long run. So I would strongly recommend that you invest in companies with a high cash flow. I found that in my experience from my portfolio that companies in the technology sector don't necessarily offer you a high dividend and they're more of a growth opportunity. So you might want to be aware that investing in technology heavily in your portfolio might be a little riskier if you are just looking for passive income long down the road. Dividends are often given out in the form of cash. However, if you're feeling fancier and really believe in the company that you're putting money into, then you can do what's called Dividend Reinvestment, or DRIP. DRIP will allow you to put money back into the company in the form of cash, and this will show even faster rates of compounding interest as time progresses. I myself use DRIP in almost all of my investments, especially those companies that I see 30, 40, 50 years down the road since I'm a young investor. Some of these companies include Johnson & Johnson, Procter & Gamble, and Home Depot. The second pro of dividend investing that I'll be talking about is growing dividend payments. Companies can raise their dividends over time based on their support, profitability, and increased earnings. This is a fantastic way as an investor to earn additional capital on your initial investment. Companies will grow this over time and you'll see significant returns very quickly. The key metric to look at here is the dividend growth rate, or the dividend CAGR. The dividend CAGR is often given out in 3 and 5 year intervals. If you see a company like Johnson & Johnson have a 8% 5-year dividend CAGR, that means on average over those 5 years, they have grown their dividend 8% year over year. Companies with a high dividend CAGR usually have a lower dividend yield. So if you see a high yield and a high CAGR, this might cause some worrying signs for you as an investor, so you might want to look a little more in depth into their balance sheet and cash flow statement. I'll be discussing the dividend yield, the dividend CAGR, and a few other key metrics to look at least the metrics that I always look at when I target a dividend stock in my future videos. So consider subscribing, and I'll leave a link to those videos at the end of this video. The third pro of dividend investing is dividends can typically outweather the storm that's coming. There's a higher likelihood that these dividend paying companies are still going to pay you your dividends during a stock market crash and correction. Dividend share price is a huge indicator of this. You don't usually see dividend paying companies alter their share price too much during a correction. However, this is not always the case, especially when there's a pandemic outside. Growth companies, on the other hand, such as Apple, Microsoft, Google, Amazon, these companies usually have higher fluctuations in their share price during a down crash and take even longer to recover afterwards. Focus on dividend paying companies that you really believe in rather than these growth opportunities with very little dividend yields. Who's ready for transparency? One big con of dividend investing is that sometimes companies can decrease the amount that they pay shareholders or cut their dividend entirely. Companies might do this because they're on a downward spiral towards bankruptcy, they're going through acquisitions, or they're just struggling financially and are seeing their profits and earnings slowly diminish over time. One big name company had this happen to them back in March of 2020. That company is Disney. Disney decided to cut their dividend entirely, and that hit my portfolio hard. I decided at that moment I'm going to take it as a learning curve. Diversify as much as possible into other sectors and as many companies as you can. Truly believe that you're going to see these companies long down the road and well into retirement. Find your success, okay? Find those success stories that you know will be there, and you will not be disappointed by seeing substantial dividend payments long down the road. The second con of dividend investing is dividend stocks and their subsequent earnings are still taxed by the federal government. There are a few ways to get around this, however, such as holding those stocks in a Roth IRA or traditional IRA, since the dividend earnings are not taxed when they're paid out to you or reinvested into the company. You see a lot of eager investors invest in REITs or real estate investment trusts because they are taxed differently in these accounts. I myself like to only put growth and value opportunities in my Roth IRA, but that's ultimately up to what you as an investor choose as your decision when investing in companies and what your long-term goals are. Here's a quick tax example of how your stocks might be taxed as a qualified or non-qualified dividend. I'll go over that in just a second. Here's a quick example of how dividends might be taxed. In this example, let's say I make $45,000, which you'll see on the left-hand side, that represents the income tax bracket. Here are two different dividend stocks that I currently hold in my portfolio: Bank of America and Realty Income. Let's take a look at how Bank of America might be taxed this year. To keep things simple, and I'll leave a link to the tax bracket in the description below, Bank of America is considered a qualified dividend because of how long I owned it, and it will be taxed at a capital gains rate because of that. Realty Income, on the other hand, would be taxed at the normal income tax rate because it's an REIT or real estate investment trust and are considered a non-qualified dividend. If you'd like to know more about taxation or whether your dividends are qualified or non-qualified, I'll leave a link to a few resources in the description below, but the main takeaway from this should be everything gets taxed at some point in your dollar's life cycle, and I don't usually worry about this as long as I'm making smart investments. If you aren't in the right mindset, then dividend investing won't work for you, and you may want to consider larger growth opportunities in place of that. The third con of dividend investing is patience. I know, right? Who would have thought? If you're new to investing or someone who's just super passionate about the stock market and finances like me, then patience is something we all must master. If you want to see significant returns of capital through passive income, then you have to be patient in order to do so. I just started my job 2 years ago, and I know this is going to be a 20-year thing for me. But I'm going to have the patience to get through it in the end. If you think you will too, then dividend investing is just the right method for you. However, if you're not, that's okay too. There's other methods if you're not as patient as that. Growth investing, momentum investing, there are other things in life that could help you and could satisfy you more than dividend investing, which that's okay. If you take anything away from this video, it's patience truly does win. Thank you everyone, and I hope you enjoyed my first pros and cons video. If you liked it, consider subscribing and leave me a like. I really appreciate it as I'm growing this channel. Thank you so much, and I'll see you in the next one. I am not a financial advisor, and this video is strictly for entertainment purposes only. Before you invest, do your own research and only invest in what you can afford to lose.